If a significant portion of a participant's 401k is locked up in illiquid investments, they could face a liquidity crisis. Even our normal public markets often face liquidity crisis where there's panic selling. It's why exchanges have circuit breakers. It's why, you think about, was it March 19th of 2000, COVID, where you had panic selling? That could be a real issue for participants.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Hi, welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers, and I'm excited you're here. I'm excited to help you have that better, that healthier retirement. Today, we're talking about current news stories. One of the biggest ones in my world is that of private equity and private credit, specifically within your 401k. And it has been much debated. Now, if you're busy living your life, busy living your best life, especially over summer, here in Minnesota, that means lakes and trails and swimming. You probably haven't paid attention, and that's okay. That's why we're here. So for years, private equity and private credit were the exclusive playground of institutional folks, institutional firms. Think massive pension funds for university endowments like Harvard, and they've actually been in the news recently as well, or the ultra wealthy. These are considered alternative investments. And by their very nature, they were off limits to average American retirement savers or savers for other things. But now there has been more and more conversation about allowing them into where most your typical American has their money, and that is your 401k. And you have to assume if it's allowed within a 401k, it could be allowed in 403bs or 401k-like retirement plans. And this poses a critical question for everyone, both those who are in the accumulation phase, still working, or the decumulation phase, which is what we mostly talk about. But if you're listening and saying, hey, this is a retirement podcast, I'm 35, you're going to find it valuable. If you are trying to make an informed decision about what could be an option in your 401k, you probably need to listen. If not, listen to me, get out your Google, your Gemini, and start drawing up some information about private equity, or be very careful that you don't choose it as far as your investment options. So this could be a golden opportunity for savers, or it could be a risky invitation to a party you might regret. It could be a party where you don't know anyone and you're standing in the corner. It could be a party that maybe does a bunch of slam dancing. It could be an eyes wide shut party. And this is a PG, not even PG-13, it's a PG broadcast. But it could be a party that's not a good fit. And much like the classic Western, the good, the bad, and the ugly, when it comes to retirement savings, it's time to be careful. So today we're going to cover the good, the bad, and the ugly of private equity and credit, and how they fit into your 401k or your retirement planning. Because we're positive here, we're going to start off with the good. And if you've ever seen this movie, it's actually before kind of Gen Xers time. But this is a classic Clint Eastwood Western. It's wonderful. I strongly encourage you to check it out. I don't think my boys have seen it, and I'm going to try to get them to do it before school starts. So the good, the allure of the exclusive. Many people argue that bringing private equity, it's often called PE firms, not to be confused with the PE ratio of your stock, which is price to earnings. So we have lots of little acronyms and funny terms. If you hear the term PE firm, it's probably talking about private equity into their defined contribution plans like 401ks. One of the good things, potentially higher returns. And most often that potentially high return comes from a illiquidity premium. And there could be other sources. They could return greater than the public market for other reasons, but illiquidity is one of the ones cited. Historically, private investments at times, key phrase at times, generate returns that outpace public markets. This is often attributed to an illiquidity premium. The idea that investors are compensated for higher returns for locking up their capital for longer periods, and private assets are not easily bought or sold. And in case you're wondering, Mark, this seems complicated. What are these things? Going through this good, the bad, and the ugly, this kind of pro and con list, I will help you understand it. So these are investments that are locked up for a certain period of time. And the trade-off for that is you potentially have higher returns than the public markets. Private credit is a good example of this. Private credit often is invested in mostly kind of high yield. I don't like the word junk, but you can look at high yield bond ETFs compared to the yield on private credit. You could think in terms currently high yield, maybe 6, 7, 8%, whereas private credit 8 to 10. So when you get in 2 or 3% on a percentage basis is quite large. If you're getting 10% rather than 7, that is a pretty big jump. That's almost a 50% increase in your yield. The rub is that there are illiquidity issues, there's transparency issues, and we're going to get into those. But number 2 on the good, diversification beyond the public market. Private assets often exhibit low correlation, or at least perceived low correlation with public stocks and bonds. This means they don't always move in the same direction as traditional investments, potentially offering true diversification, or we'll use the word increased diversification, that could reduce overall portfolio volatility and enhance risk-adjusted returns. And most people actually want this, even if they don't express it this way, especially in retirement. There's an emotional part to investing, that if there's an asset class where you can get some decent returns, but don't go down as much as the S&P 500 like it did in 2009 and COVID and the Great Depression. Most people want something like that. Quite often they want something like that, even if it means returns are muted. The potential of these private investments is that they can offer maybe the same or better returns, lower volatility. And this relates to number 3, access to unique growth opportunities. And this is a compelling one for me because there's been a structural change. And that's, as someone who's been in this industry for most of my adult life, 25 years, this is something that it's hard to deny, and I'll expand here in a minute. Private markets can provide access to more innovative, fast-growing companies before they go public. And that makes sense. There are growing companies. Obviously, these growing companies have a lot of risk, and that's an issue. But growing companies that the public markets don't have access to yet, or specialized lending opportunities. There are some folks who can't go to the banks, and it's changing, but it could change again in the next administration. The banks, if they're regulated like utilities, are not able to lend. There's good lending opportunities out there that the public markets can't provide. So this is something that often due to regulation, but not the only issue. So this allows you to have access to markets out there other than the public market that often sometimes may have even the same or close to risk as the public market. Sometimes it's not riskier, it's just different. And what's compelling to me, and this relates to small company stocks, is that there is a shrinking public market universe. The number of publicly traded companies in the U.S. has declined dramatically over the past 2 decades. Many high-growth companies remain to stay private longer, leading to what many people like me point out is a lower quality or less diverse set of opportunities, specifically in the public small cap market, like the Russell 2000. So to throw some numbers at you, around the mid-90s, when many Gen Xers were getting out of college, and some of us starting in the industry in the late 90s to early 2000, there were, depending on how you count them, somewhere between 7,500 and 8,000 firms in 1996. By 2005, this number had decreased to less than 4,000. And by 2022, somewhere between 3,400 and 4,000, again, depending on how you count the firms. The bottom line is the number of companies, if you're looking for diversification, because of whatever reason, because of regulation, because of structural changes, because of the way businesses do business, there are less public companies out there. The idea that the public companies are the only ones that you should invest in or look at or consider is just not sound investing. I'm not saying that I'm not making a statement that private equity for sure belongs in your 401k, but I am saying this is a structural change that definitely, if you are looking to be diversified, why wouldn't you want something closer to 8,000 companies to choose from like you had 30 years ago? Why would you limit yourself to half that many when you can get that exposure on the private side? Number 4, alignment with long-term time horizons. This goes specifically to a 401k, less so for retirement. If you have to lock up an investment to get that illiquidity premium or to simply get that access, forget the illiquidity premium, to simply get access to a more diversified investment, again, because more companies are private now than they were 30 years ago. If you have 30 or 40 years until retirement, and then again, another 30, 40 years before you may have to access it, if you have somewhere between, we'll call it 40 and 60 years, then locking up an investment for 5, 10, 7 to 10 years is not that bad a thing, assuming you don't have to access it. Number 5, and this one's controversial. This one, again, is kind of my take after doing this a while. I'm not sure if I've ever seen it discussed. The hidden volatility can calm nerves. Because you don't see the trading second by second, hour by hour, you don't see how the sausage is made. That can actually be a good thing for clients. If you have an asset that is not dropping 20%, and you think about some of the really bad days, like in COVID, there was that kind of the market broke, there was panic selling. Well, we'll use Liberation Day. So this is being filmed in July of 2025. If you did not look at the stock market, if you didn't turn on the news and you checked your private investment when it was valued, let's say it's valued quarterly at March 31st, and then you didn't look at it again until it was valued at June 30th, once a quarter, and you didn't pick up a news, you were on a remote island, you wouldn't have even known that Liberation Day happened, in all likelihood, assuming there wasn't, there were other factors, all else being equal. Same with the S&P 500. What was the S&P 500 on March 30th versus March 31st versus June 30th? So it's not that investment didn't necessarily go down. You just didn't see this. Well, real estate is good for folks. Some people like them. Some people like real estate because you can touch and hold it. They understand it. They don't understand the equity markets, the bond market. And also, it's not priced every second. The value of it is kind of subjective and ambiguous, which is a downside to real estate. It's also a downside to the private equity. The bad, the hidden costs and complexities. Despite some of the enticing benefits, there is definitely some upside, as I just pointed out. The characteristics of private equity and private credit introduces some challenges and drawbacks, especially for 401k plans. Number 1, illiquidity. This is a big one, and especially with 401ks. Now, as I pointed out, 401ks are long-term investment vehicles, so that should be an advantage. But as someone who has worked in employee financial well-being, people just don't treat them that way. They often think they're long-term investors. So when you think about the public markets, they're traded second by second. That liquidity is a huge deal, and there's transparency. You know at any given time what you can get for your mutual fund, your ETF, and that's a wonderful thing. But these private investments typically have lockup periods 7 to 10 years or longer. That means it's not really accessible. So as someone who has been in the real world, some of the people who are promoting this, one, they have a vested interest, but two, they don't know what the real world is like. They don't know that some of these folks will often treat their 401k as an ATM machine. It's not good, but you're introducing something that is going to intensify the harm. And you think about things about hardship withdrawals, rollovers. What happens when you have to roll over 401k to an IRA or to another firm? You have to liquidate it. Unless that other firm is going to allow you to just transfer the shares in kind. Never seen it, and that's an operational nightmare. Exactly how is this going to work? And then once you do get into retirement, you can think about systematic withdrawals. If you need liquidity, if you're planning the distributions during the decumulation phase, this is going to take a lot of planning. If you have a PE firm that you can only, or even a private credit firm where you can only liquidate it quarterly and only so many shares, this is where it takes a lot more work. So in theory, this sounds like a good thing, but in practice, especially if you've spent any time with your average 401k participant, it's not good. We're going to circle back to the university endowment, specifically Harvard. So Harvard's been in the news a lot, much like this topic, because federal government's cutting off funding. It's battled with the administration. It's borrowed money, so it doesn't have to sell its investments. Its endowment is quite large, but its endowment is also very illiquid with stuff like this. And it's a good example that when you want to ask what ifs. So you might say, I like the idea of the alternative investments for all the reasons mentioned, but there's almost very little chance that I'll need to access them. And that's probably true. The question becomes, do you want to deal with what Harvard's dealing with, this tail risk? So when I talk about tail risk, it's a probability curve that there's a very low probability that this happens. The problem with many tail risks is that if they do happen, the consequences can be pretty dire. In the case of Harvard, I've read anywhere from like 10 to 30% haircut to what the real value is because they have to try to sell these illiquid investments that's meant to be held for years early. So, and this is during an up market, an all-time high market. Just think if the market was low or the economy was in a recession. So you're not incorrect when you say, well, this is unusual. The odds of this happening are low. You're right. The odds of Harvard running into a situation like this with the federal government is low. The question is, as someone in the accumulation phase, what if you get laid off? What if your spouse gets laid off? What if your child gets sick? And, and if you're a Sona client, we work with you on things like emergency funds. We go through the what ifs, and you can't plan for everything, and you can't live your life invested in a savings account, a liquid savings account, because that has its own very real risks. But what if that was to happen? What if in retirement something went wrong? What if something didn't even go wrong? You just changed your mind. Is the benefit of these private investments worth it? So illiquidity is a big one. If you look at Harvard's predicament as it is now, it's a good example. If you're thinking about using private equity, take a look at Harvard, look at some of the choices they're going to have to make. And again, take the politics out of it. This has nothing to do with taking on either side, but we're stating the facts that they have a lot of money in illiquid investments, and now they have an emergency. maybe not their own making. That's irrelevant. They have an emergency. Many emergencies are not of our own making. And now they have an investment that they might have to sell at a substantial discount. Number two, high fees. So most 401ks, and rightfully so, have been moving more and more to more diversified, lower cost. Quite often passive funds, S&P 500, MSCI, the international one, Russell 2000, whatever it is. But because these are managed, you see them commonly charge a 2 and 20 fee, meaning 2% annual fee on committed capital plus 20% of profits, known as carried interest. Again, there's actually a lot of politics around this. Please ignore that. Just look at this objectively, try to make an informed decision with the way things are or the way things could be. And these fees obviously could erode returns. Keyword is could. If you look at the average target date fund, which is often the default for many 401ks, I think it's, we have it here, 30 basis points. So 0.3, a third of 1%. But you could certainly get ETFs that are a 10th to a 20th. But a private equity sleeve could be 2.5%. It doesn't mean that it still can't perform. From an overall standpoint, the core of even someone who believes these could have value, the overall core of your portfolio should be low cost and diversified. But the idea that you can't have anything that has a higher fee and still have it be a benefit to reaching your goals, it's just not true. You look at some of these private credit investments who the history on them is short, but again, they're returning substantially more than some of these publicly traded credit funds. So it keep an open mind. Number three, lack of transparency and valuation challenges. So private companies are not subject to the same rigorous public reporting requirements as publicly traded companies. That's a risk. There's an advantage to having some regulation. That's why a lot of people are wanting more regulation around crypto, because it builds some trust. There's some transparency. You don't have that here. So the question becomes, is the upside enough to not have that transparency? Valuations on private assets are less frequently. For example, quarterly, we gave that example. That could be a good thing. Behaviorally, that could be a good thing. And could be subjective. Now, that is a bad thing. There's just no doubt about that. The advantage one of the advantages of a capital market system, of competitive capitalism, is because you have people competing and suffering the consequences of their actions, price discovery is a good thing. But if you're relying, kind of like with real estate, on a CMA, a competitive market analysis, an appraisal, you're guessing. And you see this a lot and those who have a vested interest are, even if they think they're doing the right thing, are often, they're biased. So you see it a lot when you see real estate that's in the estate or in a trust. Other family members want to buy them. The person who wants to buy it will try to influence the subjective amount and pay as low as possible. The people who are going to benefit often want to see a higher amount. So when you have the subjectivity with something like this or real estate, it makes it more difficult. It makes it more difficult to know what you have. And it's really difficult for the uneducated investor. If you're something that's familiar with this, when you look at your statement, in the back of your mind, you kind of have that, you know that. You know that this might be overvalued, it might be undervalued, and you take that into account in your thought process as to what your portfolio looks like. The idea you're asking your average 401k investor to do that is not realistic. I'm going to quote the good, the bad, and the ugly. We should have done this sooner. The lack of transparency of the true performance and risk, as Tuco might say, every gun makes its own tune, and in private markets, each valuation can sing a different, less public song. And Tuco was talking about every gun's unique. It's a tool. It's how you use it that counts, and I guess how the how the gunfighter or how the portfolio manager uses it. So these valuation methods are something that in order to use effectively, you kind of got to know what you're doing. And I'm speaking for Tuco, the gunfighter, that it makes it challenging for the average investor. The average investor is not as skilled as Tuco or Blondie from the movie. So I hope that analogy works. Number 4, complexity. The structure and strategies of private investments are inherently complex, often leading to leverage and intricate, complex deal structures. This makes them difficult for typical 401k participants to understand and evaluate and monitor effectively. That's a big one. As someone who worked in employee financial well-being for a lot of years, it was a passion of love, honestly. It was great to work with those making $30,000 and those making $300,000. Companies would pay us a flat fee to come in. So it wasn't pro bono work, but it was a way of helping people who normally wouldn't have access to an experienced fiduciary advisor. But one thing became very clear is that what many professionals think sounds good on paper, in reality with behaviors and understanding just isn't the case. Trying to get them engaged, try to get them to engage especially if they're not educated in these things. Sometimes even if they're very well educated, they know nothing about this, but especially quite often if they don't have even a high school education, or if their English is a second language, they're coming from a different country, they have no idea what these things are. They have no idea what a stock in a company is. They have no idea what a mutual fund, ETF, what those are. The idea that you add even more complexity. When you add complexity like this, it adds friction. If this is something they're putting off, and sometimes it's out of time, and look at things in your own world. If something's overly complex, it's not your field, even if you are very well educated, you're probably not going to want to deal with it. And for some reason, there's some folks, because it involves money, there's even a sense of pride or ego involved. So this kind of complexity can make engagement even tougher. The industry has come a long way. It now has target date funds, which are not ideal. They're just a lesser of two evils. They have auto enrollment, which again is not ideal, but a lesser of two evils. So the idea that you're going to add these complex illiquid investments that valuations are subjective in many cases goes against to where the industry was headed. And you could criticize target date funds and even auto enrollment. What people really need is education and engagement for them to be doing this themselves, and adding in an investment like this, it might not be the best way to do it, even though it might be the best thing for their portfolio, but it doesn't do any good if it causes anxiety or they're too afraid to use it. So now we're moving to the ugly, the potential pitfalls and fiduciary headaches. Ugly scenarios and concerns that when private investments are in 401ks. Number 1, the Roach Motel effect for participants. If a significant portion of a participant's 401k is locked up in illiquid investments, they could face a liquidity crisis. Even our normal public markets often face liquidity crisis, where there's panic selling. It's why exchanges have circuit breakers. It's why you think about, was it March 19th of 2000, COVID, where you had panic selling? That could be a real issue for participants. Number 2, exacerbated fee erosion. And we've talked about this. The fees are bad. The ugly part is where these high fees could be combined with potential underperformance. And you look at, especially in elevated interest rate environments, where private equity has struggled to match public market returns because the cost of them to borrow and use leverage is less. Their investments have to return that much more because the cost of running these companies is higher because they're borrowing. So some of this stuff over longer periods of time could certainly work itself out in market cycles. It's why you often have these lockup periods. But the problem is, are 401k participants going to be able to ride out these things? Number 3, increase fiduciary risk for plan sponsors. Under ERISA, employers have an obligation to act in the participant's best interest. Offering complex or liquid or high-fee private investments increases the fiduciary burden. And you think about it, if they're having to analyze and study investments that are much harder to analyze and study because they're not public, that increased cost. Who's going to bear that cost? The participants. It also opens up them for litigation, that if they're afraid of being sued, or if they are sued, there's going to be someone's paying it, the employers, their insurance companies, and that's going to lead to higher cost and probably unhappy participants. And who pays those higher costs? The participants. So the ugly part of this is, again, this sounds good on paper. As mentioned, I think private investments, depending on the client and in moderation, could add some diversified excess return or risk-adjusted return, especially in our much smaller public markets compared to 30 years ago. But there are a lot of things that could go wrong. Number 4, misalignment of interest. Some critics, rightfully so, argue that including private assets is more driven by the private equity industry itself. It wants to get its fees associated with the 12 trillion, yet we have the number in 401ks, that is bigger than anything else. And whether or not this benefits the average worker. You know, if I was forced to make a call, I would say, no, it doesn't. After seeing how the average worker behaves around 401ks, and I don't blame them, they're busy. Some of them are working 2 jobs. They're trying just to do the best they can. And I fall back onto what we talk about lots of times, that if it's questionable, especially if it keeps you up at night, if there's issues with things like liquidity, if you can reach your goals with the public markets, if getting inflation plus 5 or 6 or 7% over longer periods of time in the public market can reach your goals, then why would you want to take on all the downsides of that are potentially here? So there's a clear conflict of interest between the folks who are pushing this and the individual investors, who quite often are looking for suitable, transparent, liquid options. And I'm quoting the movie again, as Blondie, the Clint Eastwood character might say, you see in this world, there's 2 kinds of people, my friend. Those who have money and those who dig. You dig. So, and we'll put the real quote. The real quote was, I think, as Tuco was being forced to dig because Blondie had the gun. So his quote was, there's 2 types of people in this world, my friend, those who have the gun and those who dig. My concern is that this push to have the private investments is more about those who have the capital and get the fees than the participants who would benefit from this. Because when it comes to liquidity, you don't want to be the one digging for your retirement funds. I hope that analogy works. Number 5, and the ugly, never been kissed. This one is, I think I've seen this mentioned before. This might be one of my own. What I mean by never been kissed is many of these alternative investments are young, like crypto is young, and they've never been really tested in down markets, at least not the way they are now. And if private investments get really big and get into 401ks, they get a big chunk of that 12 trillion in 401k money. What happens when they are tested during a financial crisis, a Great Depression? So again, I think there are benefits to having these, but we don't know. Do you want to risk the average retiree's 401k on this? You know, what I actually see probably happening is if they do allow these, I think the employers are going to just have limits. Say you can have no more than 3%. For some of those who are more experienced investors or have larger assets. That's too bad. But then again, most cases they could roll their funds out of their 401k and buy these other places. But because these haven't been tested, there's less predictability. We don't know. I think there's a lot of value in crypto portfolios. I think there's a lot of value in these alternative investments. But when it comes to, especially those in retirement, predictability matters more. Things that have been tested, things that we know that having that history gives us confidence. We know that if we stay invested in a diversified portfolio that has a reasonable cost, we can ride out these storms. They might take a year or 2 or 3. But we don't know when the system breaks, how will these private investments be affected? Will it be worse in the public markets? Because they're publics, there's less controls. And also from a behavioral standpoint, it's a lot easier for even a timid investor to stay invested when even in the back of their mind, they know their 401k that was fairly diversified, if they would have stayed invested, withstood all these storms. They don't know for sure with private equity. Could it be kind of like with crypto that in 10, 20 years, we have the history that this is a well-known, well-predictable asset class? We could. I don't think we're there yet. So the bottom line is, are you looking for stability and predictability, both in your 401k in the accumulation phase or in the decumulation retirement? There are a lot of good things about private investments. They can definitely serve a role, especially given the structural changes that we mentioned. But, and I don't like pounding the table or taking sides. I think they, when it comes to your average 401k participant, I think this, unless there are some real restrictions on these, even then, I don't trust the behavior of companies, of the participants. I think there's a lot of danger here. Especially when most people, if they are educated and start early enough, they can more than meet their goals in the public markets. But whatever you decide to do, it's about making an informed decision. I hope this podcast, YouTube channel, and newsletter all help. We have this laid out in our newsletter as well. And of course, the show notes, they'll put those in there as well. Because if you take some time to look at all options like private investments, you're probably going to have a healthier, a wealthier, and a happier retirement. Thank you for joining us. Don't forget to hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors, is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.